Jeremy Anderson, you're head of financial services at KPMG Global. Now, the markets, there's been a market downturn since the beginning of the year. How do you assess this?
There's clearly been a significant shift in investors, and I don't think there's any new news here, but I think what we've had is the realities of 2015 have come across into 2016. So what we worried about China, well, things seem to have got more volatile and more uncertain. Worried about oil, I think the oil price has now gone beyond what anybody expected, and we're now hearing of more potential oversupply coming out. And I think all this has meant that investors are wanting to get out of the market, not in an uncontrolled way, but there aren't the buyers there because everybody is seeing, I think, the realities of the global economy reflected in the market in a maybe the way that they weren't reflected last year.
Of course, there are now people appearing who already do some doomsday prognostics. People say that markets can crash by 20 or 30% during 2016. Do you share their views?
I would say unlikely, but not impossible. And the reason I say unlikely is I think the global fundamentals are all well known. People look at emerging markets and the challenges that they have and lack of growth. They look at China, they look at oil, they look at currencies. But I don't think there are any new factors coming in. But I think the markets are very temperamental, and a geopolitical crisis or a breakdown in global relationships could suddenly trigger something. So, not impossible, but I don't see that there's a fundamental reason for that happening now.
Now, shares have been very popular with investors for years now. Do you see a chain of events, a development that could lead to a situation where stock markets are less attractive to investors?
I think if people look at history, they will continue to invest in shares because we know that in the long term, almost whatever market, and whether you look at 10 years, 20 years or 50 years, shares have performed better. And I think if globally our issues now are growth and jobs, actually we want more money being invested into equity and risk capital, not into debt. But having said that, for those people who've only gone into equities because they see a better yield than they would get in other markets, maybe a little bit of retrenchment, but I hope we'll have the courage to stay in the equity markets because they are the best long-term capital provider for the global economy.
You mentioned China before. Now, a lot has been said and assessed about China, but what do you think is the most important thing that people have to keep in mind when it comes to China, when it comes to China's situation in the coming weeks and months?
I spend a lot of time in China. And I think what I've learned is that talking about China is a bit like trying to talk about Europe as one economy, because there is so much change going on. There is no doubt that there is a slowdown. There is no doubt that the economy is transitioning, but there are parts that are doing well, and there are parts that will need serious restructuring. So if you want to look at the upside, you look at what's happening with services and services growth in the economy. If you look at what is happening on the downside, you'd probably look at the overcapacity in anything to do with infrastructure or building materials. But I think now the authorities are recognizing that things are going to have to be sorted out and are starting to plan an orderly restructuring of the economies in particular regions which are very prone either to exports where they're no longer price competitive or that have just been fueling the building boom there.
You mentioned another big economy in crisis, Europe. How are you pessimistic or optimistic on Europe and the Eurozone looking into 2016?
I am slowly optimistic. I think in the short term, certainly business people I talk to, confidence is coming back. France, we're seeing slightly better figures. We're starting to see corporates wanting to invest. The challenge, I think, though, is growth and jobs. And that is the thing that we don't seem to be able to shake. And what worries me in the medium term is that we will have a very disaffected young population if we cannot find ways of doing those. So I am optimistic that we will find solutions. I think we will see growth come back slowly. The question is, what can we do to accelerate that growth? Because I think the unemployment issue is probably the biggest one that we have over and above just the headline GDP growth figures.
Jeremy Anderson, thank you very much for your insight.